Hello, everybody. I almost said good morning. It was a nice long weekend for a lot of us, so I still feel like it's Monday. I don't know about you all. I'm Betsy with Elevate Wealth Advisory, and we are already in February 2025, and we're focusing today on tax planning. This will be the fourth year that we have done this tax planning webinar. And Deanne Rosso, our president and CEO of Elevate, is just an expert in this field. She's done this along with our key financial data, which also relates to tax planning, those webinars for the past few years. And she's really honed this presentation, and I just love listening to it. I learn something new every year. So if this is your first time joining us, Elevate Wealth Advisory is a wealth planning firm based in Athens, Georgia. We were founded in 1982 by Chuck Vickery, and through the years, we have transitioned now to a team of 12 people, and we have changed our name to Elevate Wealth Advisory over the last few years. And our goal is still to help you make smart decisions with your money. So here we are with Deanne Rosso, President and CEO. Hi, Deanne.
Hey, Betsy. How are
Glad
you?
to see you.
Thank you. Good to see you too. I'm excited today. I love talking about tax planning.
You might be one of the only ones, but I'm glad that you're here to guide us on this subject that a lot of us don't enjoy talking about.
Well, I get it. So, tax, I say it's the most wonderful time of the year. And for most people, it's not. But actually, it really isn't. I mean, none of us really love paying taxes, but taxes do a lot of great things for us and provide lots of benefits and services to us. And so, it's not only our civic responsibility, but a pleasure at times to pay our fair share. But today, I want to focus on strategies to help maybe minimize that tax burden just a little bit and think about it through many of life stages. So I'm going to share my screen. It's great to be back with all of you again. Um, Let me share my presentation screen with you guys. So today, as I mentioned, we're going to focus on tax planning through life stages. And when I say it's the most wonderful time of the year and why pay taxes and what are some of the benefits that we get for those tax dollars. So we teach retirement planning classes, as many of you know. And one time I mentioned to the class, I asked the class, who likes to pay taxes? And nobody raised their hand except one gentleman. And I said, "Oh, sir, you're the, minority in the crowd here. Why do you like to pay taxes?" And he said, "Well, obviously for all the things that our tax dollars pay for that we benefit from in this country." And he is absolutely right. So here's just a very small listing of some of all the things that we count on our tax dollars to provide for us, and lots of really, really important things. So I don't want to keep that out of sight when we talk about why we pay taxes, but I think most of us want to pay our fair share of those taxes and keep that at minimum if possible. So my first tax tip always is know thy tax return. So this is just a sample form 1040 for 2024. And when I say 1040, that's just the U.S. individual income tax return. And I've noted here a few sections to pay attention to. Of course, that top about quarter section of the 1040 is your personal info, your filing status, name, social security number, address, your dependents, those kinds of things. On about midway through the page where the income section starts, and that's lines 1 through 9. So all the different types of income that you get throughout the year reported on different types of forms like W-2s and 1099s and K-1s, and all of those things that you may have additional schedules for in your tax return, that all flows through to lines 1 through 9 to report your different sources of income. And then lines 10 and 11, you have adjustments to that income, like did you make contributions to your IRA? Do you have certain expenses that you can take as an adjustment? And then line 11 is your AGI, your adjusted gross income. And your AGI is used for figuring lots of other different types of deductions and credits and so forth. So line 11 is kind of important. That's just all your income sources minus any adjustments that lands at your adjusted gross income. Then we move on down to line 12, where we report your standard or your itemized deductions. And I'm going to talk a little bit about standard and itemized deductions in a minute. And then line 15, the very bottom of the front page of the 1040, is our taxable income. And as you know, we're in a marginal tax bracket system in the US, and that means that when we look at the tax brackets, the number that we're figuring that on is our taxable income, and that's on line 15. Going to the second page of the 1040, we're looking at line 24 as your total tax. So sometimes if I ask the question, how much did you pay in tax last year? Nobody knows that answer. We generally know if we got a refund or if we owed tax, but how much did you actually pay in tax? And you can find that by looking on line 24. On line 33 is where any payments or prepayments, if you will, have been applied. So estimates, etc. And then if you got a refund, you'll have a number on line 35A, and if you owe tax, you'll have a number on line 37. So that's not good or bad either way. Sometimes you can look at it both ways. If you get a refund, that's great. You can look at it as a little bit of a bonus. You could also look at it as, oh, I paid too much in throughout the year. If you owe tax, generally, clearly, you didn't pay too much in throughout the year. You kept more of your money, but you could have penalties for not paying in enough or underestimating. So both ways you could look at that. However, just a really quick overview to become familiar with your tax return and with what numbers you're looking at when you take a look at it. So when I mentioned life stages, today I want to talk about taxes and the strategies across different life phases. And for us, we have a presentation that we call Strategies for Retirement Transitions. And we look at your life cycle in 4 phases: accumulation, when you are working, earning, building up assets for your retirement; transition, which we define as from the day that you retire or get your last paycheck, earned paycheck, until age 73 or 75, or when you start taking required distributions. And then there's distribution phase, which is from the time you start taking required distributions. Again, it's age 73 or 75, depending on your year of birth, basically through the rest of your life. And then the last piece here is legacy. What happens at your end of life and planning for your heirs and for those charitable causes. And so as I go through these different life phases, we're going to be focusing on the green stars, and you'll see what I'm talking about on future screens. And those are our opportunities for tax planning. So let's take a look at accumulation. When we're thinking about, saving during our career years, we need to take a coordinated approach to saving, investing, risk management, and tax optimization. And the ways we can do that when we think about taxes are this first green point here: match ordinary income producing assets with ordinary income tax account structure. That is a mouthful of jargon to say that we need to focus on asset location, which I'll talk about in a minute. We want to try to accumulate growth in unrealized gains. And again, I'll talk about all these points in future slides. We want to optimize that asset placement and account structure for future after-tax distributions. We want to position equities for tax loss harvesting. And then we want to manage tax bracket creep. What do I mean by tax bracket creep? Well, again, being in a marginal tax bracket system, that means that the more income we earn, the more potential there is that we will bump into the next bracket, the next higher tax bracket. So going from a 10% bracket to a 12% bracket to a 22% bracket. So managing that tax bracket creep, or as we earn more income, are there ways we can kind of stay back down in the lower tax bracket, particularly during those earning years, and even more so during those high earning years, potentially during the later years in our career. So all tax things that we want to pay attention to, and let's look at what some of those mean. We use this graphic in my office a lot. We affectionately refer to it as our tax buckets. So we have three buckets. We have a tax deferred bucket, a tax advantaged bucket, and a tax free bucket. And what we mean by these three are tax deferred means pre-tax dollars go in. And these are accounts like 401ks, 403bs, traditional IRAs, simples, SEPs, your pensions and your annuities. All those types of accounts give you tax deferral when you put money into them during your earnings years. And so maybe part of that managing tax bracket creep is putting more dollars as you can or as available in pre-tax to keep that tax bracket lower. But then in retirement, when you pull that money out, we say tax forever because every dollar is taxed that comes out because it's never been taxed before. And it's taxed at your ordinary income tax rate, meaning it's taxed wherever you fall in that marginal tax bracket. Flipping over to the tax-free, the right side of this chart, what we're looking at now are after-tax dollars going into the account. So in the tax-free bucket specifically, we're talking about Roth IRAs, Roth 401ks, Roth 403bs. We could add in here Roth simples, but this is Roth money. And the advantage to that is we put money in here after tax, so we don't get a tax deduction for putting money in on the front end. So this is not going to help you during your earnings years manage that tax bracket creep. However, when the money comes out in retirement, it's never taxed again. And also, it's been allowed to grow all that time without any tax on the earnings inside. So it's a really great deal. And we say that Roths are great sources for retirement money, but it's hard to get money in them because there are income limits, there are contribution limits. And so while it may not help us on the tax bracket creep during our early career years, maybe we want to go ahead and just pay some taxes to get money and maximize as much as we can, particularly earlier in our career, to get money in that tax-free bucket. So then it's never taxed again later. And then lastly, tax advantage is right here in the middle. And this one, after tax dollars go into it, similar to our tax-free bucket. However, these are accounts like brokerage accounts, just regular investment accounts or savings accounts, accounts that generate qualified dividends and capital gains. And so what happens in this bucket is you put dollars in after tax. The money inside of it grows, and you have some components to that. You have interest that may come in, and that interest may be at a lower tax rate. It may be ordinary taxable. You have dividends and you have capital gains. And those types of income to that account can be taxed every year. So you're going to have some dividends and some capital gains that come into that account that get taxed every year, but they typically get taxed at a lower rate than our ordinary income tax rate, a lower rate than our marginal bracket. And right now that structure is a 0% or 15% or a 20% if you're a high income earner. And so this is why we call this bucket tax advantaged, because then when the money comes out in retirement, what we pay tax on is not the whole account, but only the portion of the growth that's never been taxed. And we pay that at typically a lower rate than our ordinary income. So on the left side, I have here, first bullet point is save strategically. And that's because if we can save across all of these three buckets strategically, then thinking with the end in mind, when we get to retirement, we're going to have the different buckets, levers to pull in order to manage our tax bracket through retirement. And asset location is really important. I mentioned that on the slide before. So what we want to do is we want to take advantage of the different types of accounts, their tax treatment, to position assets in a certain way. So for example, bonds. Bonds are a really important part of an overall retirement portfolio, or not even in retirement, but just planning for retirement, just an overall portfolio. But if you have all three different types of accounts, where we want to put those bonds is typically in that tax-deferred pre-tax bucket. And that's because bonds will generate interest that's ordinary taxable. We don't get a favorable tax rate on that. And why don't we put that in an account that we're going to get ordinary tax treatment on it forever anyway? And then that gives us the opportunity to locate assets like stocks, what we also might call equities, in Roth or in after tax accounts. And we may put those in Roth accounts because we want to get aggressive growth. And we may put those in after tax accounts because not only do we want to get growth, but we only want to be taxed on the portion of the money that grows. And then we want to be taxed on that at a lower income rate than our ordinary income tax rate. So, where you position assets and what type of account matters. It'll make a big difference in the long run. And that's where unrealized gains comes in as well. Using those unrealized gains, we don't really care whether a dollar of retirement income comes from a dividend or a capital gain, because either way they're taxed about the same, particularly from that tax advantaged account. Um, so that we want to make sure that we can get those in that tax advantaged account so that we pay a lower rate on those, whether that's during our accumulation years or beyond. And then lastly, tax loss harvesting. And I included an example of tax loss harvesting because it sounds counterintuitive. So I always like to explain how tax loss harvesting works. So I'll flip back for a second. Tax loss harvesting is something we do in the tax advantaged or this middle bucket in our just regular brokerage investment account. And what we might do is we might buy ABC investment. We're going to buy some investment, right? In this example, we bought ABC and we spent it cost us $100,000. Okay. Then let's say market tanks and it goes, that particular stock loses 20% of its value. So it's down to $80,000 now. Well, if we don't sell it, what that's called is an unrealized gain. Our $100,000 investment is now worth $80,000, but that means nothing. It's just on paper unless we do something with it. And if we sell it and we reap the $80,000, then what we've done is we've booked a $20,000 loss that we can use to help offset future capital gains, because we can offset gains with losses. And so we want to try and do that strategy. But if you just do that strategy, those two parts, it doesn't make any sense because all you're doing is selling when the market goes down. So what we have to do is step number 3, which is rebuy something. So we don't want to lose the market potential, right? So when we sell the investment in step 2, we immediately rebuy something else, a different investment, XYZ, something that we expect to have similar participation in the market. And in that way, we don't lose the appreciation when the market goes back up. It's interesting after having done this for a number of years, and it's hard to believe now this is my 20th year with Elevate, and I get to see now 20 years worth of these examples. And it's interesting now to look at clients' accounts who we've been tax loss harvesting that, we've captured those losses, helped offset gains, and didn't lose the market appreciation. And the account value bounces back and even goes higher. So that's an example of tax loss harvesting and why that can be an important part of a tax strategy in your brokerage account. And then I have on here your BFF, the HSA. So why is the health savings account, why would I consider that a best friend forever? And that's because I showed you the 3 buckets. The health savings account should get its own bucket. It should get its amazing gold star, really pretty bucket, because a health savings account has the best tax advantages of any type of account. And that's because money that goes into a health savings account is not taxed. And if you spend it for medical expenses, when it comes out, it's not taxed either. So it's basically like a Roth IRA on steroids. You put money in, it's allowed to grow, and you are allowed to invest it. And then when you take it out to use it for approved medical expenses, it's not taxed then either. Now, there are caveats, of course. If you thought it was hard to get money in a Roth IRA, it can be even harder to get money in a health savings account because you have to have a high deductible health plan that allows for HSA. And a lot of people think you have to do an HSA through your employer, but you don't. You can open an HSA on your own and fund it on your own. And sometimes I recommend that if you're going to do this strategy of saving the HSA dollars and not spending them, because what you can do is you don't have to spend that health savings account money this year on your health costs or next year or the following year. You can allow it to grow for years and years and years. And then when you get into retirement, you can do two things. You can pay your Medicare premiums with HSA dollars, therefore making those expenses tax free, and any out of pocket expenses you have for Medicare, you can use your HSA for that money. Um, and then the other thing that you can do with your HSA is you can reimburse yourself for expenses from prior years. So if you kept all your receipts and you never reimbursed yourself for out of pocket medical expenses, um, I like to use the example of, let's say you need a car in retirement, and your two choices are, and this is, most people have more choices than this, but let's just say that in this example you could either take the money out of your IRA or you could take the money out of your HSA. Well, we could take the money out of our HSA to buy the car, but that's not a medical expense, right? But what if you had receipts from years back that totaled up to the amount that you needed to pull out for the car? Then you can pull that amount out of your HSA, reimburse yourself for those past health expenses, and buy your car tax free, basically. Um, Otherwise, you'd have to pull the money out of your IRA and you would need to gross that dollar amount up to account for the additional taxes it's going to cost you to bring some of those forever tax dollars out of that IRA. So you can get creative with your health savings account. So I highly recommend you have one if a high deductible health plan is right for you and you have the ability to maximize it. All right, transition. So moving on from accumulation, transition is a very narrow window of time. It goes from the day that you receive your last paycheck until you're age 73 or 75 when you start taking required minimum distributions from your retirement accounts. But this can be the most flexible time that you have when it comes to your income. So we want to look at the green dots here. Optimize your tax strategy for life after work. Project that adjusted gross income, estimate that in retirement tax rate, develop tax rate bracket strategy. What do I mean by that? We're going to look at all of these things and project your tax bracket at 72 or 73 or 75 with no tax optimized planning so that you can see the difference between optimizing for taxes and not optimizing. So let's take a look at what some of these things mean. Work the brackets. If you, I always do a webinar, or I typically do a webinar in January. I did this past month called Key Financial Data. For this one, obviously, is for 2025. If you didn't get a chance to take a look at that one, I would recommend it. I go through this Key Financial Data card, and really 90% of the information on this card is about taxes. And so I reference this a lot. I reference this a lot in presentations. I reference it a lot daily when I'm working personally with clients in their tax planning. So we want to look at the tax rate schedule and we want to work those brackets in your favor. And what saving across all those buckets does is it gives us the opportunity to say, particularly during those transition years, it gives us the option of saying where we want to pull income from so that we can decide what income bracket that we end up in. Because if you think about it, if you retire at, let's say, age 62, just for illustration purposes, it could be 65, it could be 70, but let's say you retired at 62. Well, the decision to take your Social Security and when to retire are two separate decisions, right? So you could retire at 62. You're not yet bound to take your Social Security. You're not yet bound to take a company pension. You're not yet old enough to qualify or have to take required minimum distributions. So you have all the flexibility to decide where you want to take your income from. And if you've done a good job of saving across those three buckets, then we can say, okay, we want to take, if we're married filing jointly, we want to stay in the 12% tax bracket. So let's go up to $96,000 of taxable income, which, remember, we also have to account for your standard deduction in there. And if you're married filing jointly, that's 30,000. So 106. So that's actually $116,000 of income that we can take from that traditional IRA and be in the 12% tax bracket And then we could take the rest of it from a Roth, whatever else you need for your expenses. Or we could do something else. We could bump the bracket with Roth conversions. The best time to work on converting assets to Roth IRA, and what I mean when I say converting is moving assets from traditional IRA to Roth IRA so that you get those tax-free dollars in retirement. But when you make that transition, you have to pay taxes. So pouring from one bucket to another means paying taxes, but we can be strategic about it. So the best time to convert to Roth IRA is when you're in lower tax bracket. And when are some times when you're in a lower tax bracket? Well, either during your career years when um, something has happened, maybe you took time off intentionally or unintentionally. Maybe something happened. Maybe you own a business and it wasn't as good a year as other years. So when your bracket's lower, consider converting. During that transition period is a great time to convert every single year and fill up that next bucket. So to look at that, if before the conversion with your income, you filled up the 10% bracket and you filled up the 12% bracket, but you've only about halfway filled up the 22% bracket, and that's just the normal regular income that you need, then maybe we want to consider filling up the rest of that bucket with a Roth conversion and not spilling over into 24. Or depending on your income and where your ordinary income bracket falls, maybe you do want to spill over and fill up also the 24. Really just depends on your situation. But in general, we want to make sure that we fill up 10 and 12 for sure. So if you've done a really good job of saving across your three buckets, then maybe we don't even have the 12% bucket filled up and we can fill the rest of that up with Roth conversions. So bumping the bracket helps us move as much money as possible from IRA to Roth IRA, where, if I haven't mentioned this in this webinar already, Roth IRAs don't have required distributions. Even if they did, they'd be tax-free. But what you're doing is you're moving dollars that you're required to take out later, going ahead and volunteering to pay some tax on those dollars now in order to get them in a place where those dollars and all their growth are tax-free later forevermore. So I love bumping the bracket strategy, particularly in the transition phase. And then another strategy, particularly during transition, is raise the standard, bunch your deductions. And here's my deduction bunch, because these now, under the current tax structure, are the things that we can typically deduct. The big three: mortgage interest, state and local taxes or SALT, and charitable gifts. And then there are others: property taxes, medical expenses, investment interest expense, disaster losses, and miscellaneous expenses. Those are rarer and rarer because it's a short list of those things. And usually that means some type of loss. But if you want to take the itemized deduction instead of the standard deduction, which I have the standard deductions listed here. So for this year, for a single filer, it's $15,000, and for married filing jointly, it's $30,000. And if you're over 65 or blind, you get an additional $1,600 per person in that standard deduction. So in order to itemize, you got a pretty high bar to meet as far as how much you need in itemized deductions. So maybe you want to think about a year where you make a large charitable gift and add that to your mortgage interest, your SALT, your property taxes, and maybe you had medical expenses that year as well out of pocket that you can add all that in. And maybe in one year that gets you over the standard deduction and you can itemize. And you can get more of a benefit for that charitable gift than you would in just a normal year under a standard deduction. Because if your itemized deductions don't add up to more than the standard and you give charitably, at this point now, you're not really getting a tax. Now, we give from the goodness of our hearts and because we like to support those organizations and charities and things that mean so much to us and give back to our communities. But it's also nice if we can get a tax benefit from them too. So if we do a little bit of planning, we typically can. And here is also another charitable giving strategy. Actually, this one pairs nicely with the itemized deduction strategy. So I have doubled down with DAFs. And that's because contributing to a donor advised fund is essentially a double tax benefit because the donor contributes. So you set up a donor advised fund, you make a gift, it's irrevocable, meaning you cannot take it back. You immediately get the tax benefit for making that gift. The assets can grow, so you can invest that donor advised fund. And then charities benefit. So you don't have to grant out the funds in your donor advised fund all in that single year. You can make one gift, one large gift to your donor advised fund, and then you can use that to grant out to charities over this year and next year and the following year and beyond. And the donor advised fund can outlive you, and your heirs can give from it. And so it's a great hub, if you will, for making a big gift to the donor advised fund, deducting that, maybe that helps you get over that hump of being able to itemize your deductions on your tax return. And then that provides the funds that you need for your charitable giving wishes for the next few years. And when I say it's a double tax benefit, the other benefit we can get is what if we have some stocks or bonds or securities in our brokerage account that we paid this much for and they're worth this much, meaning their basis is low and you've got a lot of growth on that asset. We can, if we were to sell that asset, we would owe capital gains taxes on that gain. That would be a realized gain. But if we don't sell it and we transition that stock directly or bond or whatever the security is directly to our donor advised fund, we also give away the gain that we don't have to pay tax on. So we can get more bang for our buck, if you will, by giving appreciated securities to either the charity directly or to a donor advised fund to then use for our giving strategy in the long run. So that's what I mean by doubling down with DAFs. Okay, distribution phase. So distribution is basically starts when the time you reach age 73 or 75 and your IRAs, 401ks, retirement, pre-tax, your tax deferred bucket accounts now have required distributions. So let's look at the green. We want to identify non-portfolio 1099 income sources. We want to fund our remaining lifestyle spending with our lowest tax cost investments. So that's really the only two tax points on here, but there are a few others. We want to project that taxable income. We want to sell equities with high basis in up markets. And define our cost of retirement lifestyle before tax. So some of these other things have to do with taxes. At 70 and a half, we want to fund our charitable goals by QCD. So distribution phase, we've now gone through transition where we chose when we wanted to start our Social Security and start our pension, and now we've started RMDs. So our income sources are pretty much locked in at this point. And where transition can be a little bit different year over year as to where we take income from for the strategy, we kind of come to a better place in distribution phase where it's more steady and predictable year over year. So QCDs, if you please. This is another giving strategy. And if I have to break down giving strategies pre-distribution phase and post-distribution phase, pre-distribution phase, I want to use things like donor advised funds or giving appreciated securities. Starting with at age 70 and a half, which is actually just a couple of years before this technical distribution phase, but at age 70 and a half, you can do what's called a qualified charitable distribution, which means that you can give up to $100,000 from your IRA directly to a charity, and it's not reported as income, which means that monies in that tax deferred, that pre-tax bucket, you can pull that out without paying tax on it. And that's the only way that I know of to pull money out of there without paying tax on it, is to give it directly to a charity. So this is a great strategy for your charitable giving once you reach age 70 and a half. Okay, and things to watch out for. Dominoes, torpedoes, and cliffs, oh my. And these particularly apply in that distribution phase because, like I said before, you've locked in those income sources. And so we've got the extra income domino effect. What do I mean by that? Well, every dollar extra that you take, let's say that we've projected your tax bracket, we know what your Social Security is, or is going to be, we know what your pension is, we know how much normal income that you need above that, so we've projected a certain tax bracket. Every dollar extra above and beyond that you take can tip another domino. So there are things like mm, extra, not extra tax, but Social Security tax. I'm going to talk about that in a minute. Social Security tax torpedo. What about net investment income tax? What about, and I've got Irma Cliff on here too. Um, there are just certain things that when you take another dollar of income, you don't realize that that might trigger another tax elsewhere. And so we just have to be mindful of projecting that income that you need and giving ourselves a buffer so that we know when you're going to step up to that next bracket. We know when you're going to get hit with a different tax that's based on that adjusted gross income or that modified adjusted gross income. The Social Security tax torpedo is one of those things. Um, if you have access to that key financial data card, which I believe Betsy is going to drop in the chat box for you to download, there is a box on the back side that shows taxation of Social Security. And if you are under certain income levels, your Social Security is not taxed. But $1 more, and this is that extra income effect, could push another dollar of Social Security income into being taxed, all the way up until your Social Security is up to 85% taxable. So it's something to pay attention to. If you've done a really good job with your strategy across the board of making it where your Social Security is not taxable, taking extra income sometimes can lead to like an 80 or 90% extra tax on that dollar simply by adding in another dollar of Social Security that's taxable. And then lastly on this slide is the IRMA cliff. And what do I mean by that? IRMA refers to income related monthly adjustment amount, and it has to do with your Medicare premium. So there have been years, I have another seminar, and we're teaching a retirement planning class right now, and I'm teaching about Social Security. And there have only been like 3 times in history that Social Security has not given a cost of living adjustment, that cost of living adjustment has been zero. It's never been negative. But there are times when I get a call from a client who says, "Oh my goodness, my Social Security payment went down this year. I thought Social Security gave a raise." Well, it's not because the Social Security went down. It's because their Medicare premium went up because they went over what's called the IRMA cliff. So your Medicare Part B premium and Part D premium is based on your modified adjusted gross income. And if you are in higher income brackets, or let's say you had a year where there was an anomaly, something happened like you sold a business or you sold a piece of property that you inherited and it generated a really large capital gain. Things like that can cause your Medicare premium to go up because your income for 1 year went up, but you won't know it until 2 years later because the IRMA doesn't apply until 2 years after the year when the incident occurred, when the higher income situation occurred. So you also have to pay attention to the IRMA cliff because that is truly a cliff. If you go $1 over that bracket, which is also listed on the back of that, the second page of that key financial data card on the top right, if you go $1 over that cliff, your Medicare premium is higher for you and for your spouse for that whole year if you are married filing jointly. The good news is it's only for that year. So if it was an anomaly, then you only have to pay a higher premium for that 1 year. If it's not an anomaly and your income just happened to leap up into that next bracket and we can't figure out a way to maybe bring it back down, then you may be stuck in that next IRMA tier. And then lastly, legacy. The legacy is a period of time when either we're planning for our end of life or those last few weeks, months, years of life, and beyond when assets transfer to heirs. So some of the tax things we want to pay attention to. Um, and I really like this phrase on this slide. This phase's goal is to positively impact the client's wealth on the lives of others, either heirs or charity. And so you can do some strategies in order to provide your family a double step up in basis. You can help them create a strategy for 10-year inherited IRAs. Avoid tax of liquidating assets and distributing to heirs. So, and transfer assets in a tax efficient manner. So, all of those things, and ensure assets are titled properly. This one is so important. And so, all of those things are definitely things that can be planned upon before your death in order to make asset transfer easier and more tax efficient for your heirs afterward. So organize your assets for your family's benefit. Estate planning still matters. And let's talk about why. Um, this example is a step up in basis strategy. And so the definition of this is this rule treats a beneficiary as if they purchased the inherited asset on the day it was left to them. Future gain or loss is based on the asset price on that day. And I mentioned a little bit ago, now having done this for as many years as I have, I've actually seen this strategy. Unfortunately, I've seen this strategy in action, and I've seen it work really well for surviving spouses and families. So let's talk about Phil and Mary. They hold taxable investments in a joint brokerage account. It's joint tenants with rights of survivorship, and they $120,000 in investments. They have a long-term capital gain. And then sadly, Phil is diagnosed with a terminal illness, and it's projected that he has 18 months to live. So, as we all know, we never know, when our last day is. But having been diagnosed with a terminal illness gives us a little bit of expectation of based on, longevity of what we can expect. So, if we did nothing after the diagnosis, meaning nothing with the accounts, and then Phil dies, Mary inherits Phil's half of the joint account, and she inherits half of the account at that step up in basis. So that eliminates the long-term capital gain on Phil's half. And so if she sold all the investments in that account, she'd owe only the income tax on her gains. So her gains equals long-term capital gains on her 60,000 plus any gain on the remainder after Phil's death. And so the bottom line is Mary still would owe tax on her $60,000 of gain because she only inherited Phil's half. Okay. If we had done a little bit of pre-planning based on that diagnosis, we could have moved all of those investments into one account in Phil's name. So rather than it being joint with right of survivorship, because spouses can gift assets to one another unlimited, we could have just put the whole account in Phil's name only. And then sadly, he passed away 18 months later, but now Mary has inherited Phil's account and the entire account steps up in basis. And so if she were to liquidate that entire account, she would owe $0 in taxes. Now, it's really rare that when someone passes away, we're going to liquidate an entire account. But the point is, if she's utilizing this account for income, she now doesn't have to worry about paying so much in capital gains taxes because now she's inherited the entire thing at a new basis and zero capital gains tax. And then she only has to worry about growth going forward from that point. So it's one of these strategies that, during these times in life, sometimes we don't want to think about what should we be doing? But I've found actually in my career that I have more clients and people who, when this is their news, they want to think about those things and they want to take action and they want to set things up appropriately to make things easy and more tax efficient for their survivors. I mean, this just, when you go to sell your investments, would you rather owe tax on $60,000 of gain or no tax? And I think we all know the answer to that. Although the little asterisk down here, always consult a tax professional before taking action. I should have said this at the beginning because sometimes people ask us, like, why do you focus so much on taxes? Isn't that for my CPA? And yes, it is for your CPA. And so any of these strategies, we want to make sure that you are talking with your tax professional about before they're implemented for your situation personally. And we always recommend that you have a tax professional. So when you inherit IRAs, you have choices. An example, Pamela is 65 years old and her son Kyle is 40. And unfortunately, Pamela dies. I know the presentation is getting really depressing. Pamela dies and leaves 100% of her IRA to her son Kyle. So note she's leaving it to her son, not to a spouse. So this section is about non-spouse beneficiaries. If you're a spouse, that spouse can take on that IRA as if it's their own when you pass away. But if your beneficiary is a child or a friend or someone who is a non-spouse, then we have to decide how to treat that. So Pamela's IRA balance when she left it to Kyle was $400,000. We're just assuming a 6% average rate of return. So in this scenario, Kyle takes distributions over 10 years to minimize the tax. So inherited IRAs now have a 10-year distribution rule. And what that means for non-spouse beneficiaries. And what that means is if you're not a spouse and you inherit an IRA, you have 10 years to distribute the whole account. You can take it all at one time in 1 year. You can break it up evenly over 10 years. You can take more some years than others. All you have to do is take a required minimum distribution that's calculated based on your life expectancy every year. And by the end of year 10, you've got to distribute that entire account. So if Kyle takes 10 distributions over 10 years to minimize the tax, his annual distribution is $54,347. And why that's important is if Kyle is working, he's going to have his own income, and then he's going to add to that $54,347. Okay. And that's going to potentially bump his tax bracket up. So he can think about some things too that might help bring that tax rate down. But he will sort of know that about every year he's going to have $55,000 to take in additional income that will be ordinary taxable to him. Scenario 2 is Kyle takes minimum distributions in years 1 through 9 and then takes the rest of it out, the full distribution in year 10. So this is definitely an option, and it may work well for some people. In this situation, instead of Kyle adding $55,000 to his income every year, he's adding more like, I don't know, $2,000 to $5,000 a year, more like $2,000 a year in income every year. But then in year 10, he's got a distribution of over $700,000 that he's got to take. And what do you think that does to the tax rate? All of a sudden, his tax bracket skyrocketed because he has to take this huge distribution. And so, again, sometimes this is the strategy. Sometimes, if you're a high income earner now, you only want to take the minimums, anticipating that maybe by year 10, you're retired, and maybe that's all the income you take in that year. But for others, it may make more sense to try and take an even distribution each year and keep that tax bracket managed and under control. And also, you don't have to spend the money. So just because Kyle, has to take out $55,000 a year, it doesn't mean he has to spend it. He can take that amount after tax, put it back in that middle bucket account. If he's eligible, he could use some of it to make a Roth IRA contribution. And that way he's redistributing those funds in a better tax position for him later on down the line. And that is the 4 phases of strategies for retirement transition. And the tax, a lot of the key tax things that we want to highlight to make sure that during each phase, we're doing the things that we need to do in order to maximize your tax efficiency over time. And so obviously it's a lot. Like I just went through a ton of strategies. How do you know which ones apply to you? How do you know what you should be doing in accumulation versus transition and etc. And that's what we're here for. So never walk alone. Um, I personally am a band kid. I grew up in the band. I played flute and piccolo and a little bit of clarinet as well. And whenever I hear Never Walk Alone, that's the song that You'll Never Walk Alone was always our band warm-up song. And so I always like to throw musical references in some things, but never walk alone when you seek professional tax guidance. Everyone's situation is different. And so it's really important that, like I mentioned earlier, you have an accountant because correct data entry is essential. We look at a lot of tax returns. We recommend a lot of strategies that sometimes when we get the final return, we're looking at it and, ooh, maybe that qualified charitable distribution wasn't put in quite right. And so we've got to go back and fix that to make sure you get the tax advantage for that or certain things like that. No tax prep is ever 100% perfect all the time. And so it's good to have a second or a third set of eyes. And that's why collaboration is key. I like to say your dream team consists of you, your accountant, and your advisor, along with other professionals like your estate planning attorney or your insurance specialist, just to make sure that your well rounded plan is all put together in the way that it should work, coordinated best for you. And with that, we just want to leave with something I always tend to wrap up with because what is it that we do for clients and what can we do? And we want to focus on what we can control because there are hundreds and thousands of things that are outside of our control. We don't control markets. We don't control politics. We don't control Mother Nature. We don't control world governments. So, what are the things that we do control? And we narrowed that down to four basic things. We control costs, what we pay for our investments, what we pay in our portfolio, what we pay for things. We have choice in that. Taxes to some extent, that's what this whole webinar was about today. And so that we do have some control over the taxes that we pay. Risk, we want to make sure that your risk level is right for you in two ways, that it's the risk you're comfortable with, also the risk you need in order to achieve those goals. And then lastly, decisions. I renamed this from behavior to decisions because um, a famous financial writer named Nick Murray that we read a lot, a quote of his is, "The dominant determinant of investor performance is the behavior of the investor themselves." And so making sure that you are focusing on what you can control and letting the plan and the strategy work for you is one of the most important things you can do. And that's what we're here to do, is to help you do that. So I think that is it. You can request a meeting, taxes and retirement planning overview or whatnot with us. Clearly, I'm passionate about the subject and I love talking about it. And so I really like looking at clients' tax situations and seeing where we can add value in that way. So with that, I will stop my share and pass the proverbial mic back to Betsy.
Got it. Thank you. Dan, thank you so much. That's my third time sitting through this webinar, and I learned something new every single time. We will be sending a link to the recording of this webinar out, so you might want to watch it again just to make sure that you didn't miss any little nuggets. And also feel free to share it with your friends or your family. We do have a few questions, and so if anyone does have a question, you can put that either in the webinar chat box or the Q&A box, or you can email marketing@elevate-wealth.com, and I'll make sure Deanne gets your question. So this one comes from one of our viewers. The distribution phase seems to have less flexibility because you're receiving Social Security and are required to withdraw a certain amount and pay taxes, whether you need it or not. So when should you start looking at what you own and where you own it?
Oh, today. No better day than today.
Perfect.
Um, just to make sure that, yes, asset location, what you have, where you own it, and how you're saving across those buckets. And I say today, it's also never too late. We love to say it's never too late to make a bad investment decision. It's never too late to make a good it's never too late to make a good investment decision. It's never too late to make a good planning decision. And so today, wherever you're at in that life phase, I do feel like there are things that we can do to structure a portfolio in a way to help optimize your tax efficiency.
Perfect. And that segues into our next webinar, which will be on investments. That will be next month on the third Tuesday. And I also wanted to mention we are doing a retirement planning class in Hartwell. We are just wrapping up our Athens classes. We will do another one this summer. If you'd like more information about that, it's marketing at elevate-wealth.com, and I'll send you all the details. And then we also have some exciting news internally that I'm going to let Deanne share in case you have not heard yet.
Oh, yeah. So we're moving our office. We're excited. We have been in our current office location now for 13 or 14 years, and we're busting at the seams, and that's a great thing. And so we are renovating our new office space now. If you are in the Athens area, we're going to be off Daniels Bridge Road, and we look forward to welcoming you to our new office come late March. So in just a little over a month.
We are so excited. And I did post some pictures on our social media. So if you aren't following us on Facebook and Instagram, be sure to check us out because you can see some of the pictures of the office and follow along as it evolves. Again, thank you so much for joining us. We'll look forward to seeing you next month. If you have any questions, email marketing at elevate-wealth.com and we will see you soon. Thanks so much, Deanne.
Thanks. Thanks, everybody.
Bye-bye.